David Zervos, you were talking about the unrealistic expectations that some in the market had about what was going to happen with rates and cuts. And I wonder, I mean, we're down off the highs today, certainly. We're not used to too many down days, but this isn't down that much. How are you thinking about the next important signals from here that the market needs to pay attention to?
John, I think it's really, as the chairman said, as Jay said, this is about data and how comfortable they are with inflation and how the employment picture evolves. We're as data dependent as I can remember at any time in the Federal Reserve's policy reaction function. And I think they want to go. They want to declare victory. I think they, in spirit, have already done it by telling you this is what they want to do. But they're going to be cautious and careful. And I think they're right to be cautious and careful. And I think the market's probably going to reward them in the end for maintaining that credibility and not kind of giving in too early to those that are whining about, well, we need to have our rate cuts because maybe something's going to go wrong. You know, if something goes wrong, they can cut, and they can cut pretty fast. They have the put. You know, the put is back. We all know it. If they need to go, they can start doing 50s and 75s if something really bad happens. So let's let them do their job, make sure inflation expectations stay anchored. And you know what? We are pretty much at full employment. This is a 3.7% unemployment rate. Yeah. Their job is maximum employment and price stability. Guess what? Maximum employment, we're there. Price stability, we're not exactly there. They think they're restrictive, so maybe they can bring that restrictiveness down a little bit because of their views on inflation. But we're talking about tweaks here. We're talking about a 25 here to 25 there. The market going to a full 150 of cuts super fast, you know, that's consistent with a view like what Jeff Goodlock might be saying, where there's a big recession coming. Sure, that could happen, and the Fed will have your back. And that's actually a really good thing for risk assets, something we haven't had in the last 2 years.
Finally, last word, Charlie, you talk about big tech stocks being priced for perfection. The Russell certainly is not. It was down close to 2.5% today, I believe. So how should investors think about the smaller stocks where they're supposed to be able to find some value in this market, but they seem to get beat up worse on these down days?
There's no doubt that smaller stocks are more sensitive to the economy. There's no doubt that the economy is sensitive to rates. So this was bad news for housing stocks, for general cyclical stocks. I think that small cap stocks are attractively priced, but there's no doubt that they pay more attention. They react more to the U.S. economy. And Chairman Powell's comments today, all else equal, were not great for the economic outlook. He seems to be stubborn. He's not paying attention to the data in the way that he says he would. The data has been overwhelming that inflation is coming down fast. And so it's disappointing to people who are running businesses that are dependent on the economy.